Imagine waking up one morning, checking your credit score, and it's dropped. Not because you missed a payment, not because you took on new debt, but because someone changed the rules while you were sleeping. That's not a hypothetical. That is exactly what is happening in 2026. And the uncomfortable part? Most people won't even know it happened until it's too late. Until they apply for a loan, a rental, or a credit card, and the number staring back at them is not the number they thought they had. So today we're going to talk about what actually changed, why it changed, who benefits from it, and, most importantly, what it means for you in real, practical terms. Not the sanitized version. The actual version. Credit scores have existed in their current form since the late 1980s. For almost 4 decades, the basic logic stayed the same. Pay on time, keep your balances low, don't open too many accounts, and your score goes up. Simple, stable, predictable. But 2026 broke that stability. This year, FICO, the company behind the score that roughly 90% of U.S. lenders use, rolled out significant updates to its scoring models. At the same time, the Consumer Financial Protection Bureau pushed forward new data reporting guidelines, and the 3 major credit bureaus, Equifax, Experian, and TransUnion, began operationalizing changes to what they actually report and how. All 3 things happening at once. That is not a coincidence. That is a system being restructured. Before we get into what changed, you need to understand what you were working with. Your FICO score, the number between 300 and 850, was calculated using 5 factors. Payment history at 35%. Credit utilization at 30%. Length of credit history at 15%. Credit mix at 10%. New inquiries at 10%. Clean. Logical. Except, it was never actually that clean. Here's the thing most people don't realize. There is no single credit score. There are dozens of versions of FICO alone. FICO 8, FICO 9, FICO 10, FICO 10T, each used by different lenders for different purposes. Your mortgage lender might be pulling a score based on a model from 2004. Your credit card company might be using something more recent. You, checking your score on a free app, might be seeing a Vantage score, which is a completely different scoring system built by the bureaus themselves, not FICO. So when someone says, check your credit score, the honest answer is, which one? This was already confusing before 2026. Now add the new changes on top of that. 3 things, and each one matters differently. First, FICO 10T is being adopted more widely. The T stands for trended data. Older models looked at a single snapshot. What is your balance today? What is your utilization today? FICO 10T looks at trajectory. It asks, is your debt going up over the last 24 months, or is it coming down? Are you someone who pays in full each month, or are you a minimum payment person? On the surface, this sounds more fair, more nuanced, more accurate. But here's the uncomfortable math. A person carrying a consistent 20% utilization who pays on time might have scored the same under the old model as someone who went from 5% to 35% utilization over 2 years. Under FICO 10T, they don't score the same anymore. Trajectory now matters as much as current position. If your debt has been creeping up quietly, even within what you thought were safe limits, your score now reflects that direction, not just the destination. Second, medical debt reporting changed. This one actually cuts the other way. Following regulatory pressure and bureau-level decisions, most medical debt under $500 was removed from credit reports, and medical debt that has been paid off can no longer appear at all. That sounds like good news, and for millions of people it is. Studies suggest this change added points to roughly 15 million Americans' scores. But here's the irony. The people who benefited most from this change were often people with thin credit files, meaning fewer accounts, less history, which makes them simultaneously harder for lenders to evaluate. A score going up because negative information was removed is not the same as a score going up because financial behavior improved. Lenders know this. They're adjusting their internal cutoffs accordingly. Third, buy now, pay later. Data is beginning to enter credit reports. BNPL, the Klarna, Affirm, Afterpay model, was essentially invisible to credit scoring for years. You could rack up 5 simultaneous installment plans, and none of it would show up. That is ending. BNPL accounts are starting to be reported to bureaus, and the way they're being categorized is not yet consistent. Some are being treated like installment loans, some like revolving credit. The classification changes your utilization ratio, your credit mix, and potentially your score, in ways that are genuinely unpredictable right now, because the industry hasn't standardized the reporting format yet. You might have BNPL accounts and not realize that they are about to become visible, for better or worse. Every time credit scoring changes, there is a version of the story that is designed to make you feel like this is finally the system becoming fair. More data, more nuance, more accuracy. The press releases from FICO and the bureaus will say things like better predictive power and more consumers will qualify. And some of that is true. Medical debt reform is genuinely positive for a lot of people who were penalized for things outside their control. But let's be honest about what the system is actually optimizing for. Credit scores exist to help lenders predict whether you will repay debt. They were not built to represent your financial health. They were not built to capture your saving habits, your net worth, your financial resilience. A person with a paid-off house, a 6-month, here's where it gets bigger than just your personal score. As alternative data becomes more integrated into lending decisions, BNPL history, rent payment history, utility data, the credit system is expanding its reach into parts of financial life that were previously private or uncounted. That expansion can help people who were previously invisible to traditional credit. First-generation credit users, immigrants, young people without credit history. But expanded data cuts both ways. More data means more ways to be penalized, not just more ways to be helped. And the entities controlling that data, the bureaus, the BNPL platforms, the lenders, have financial interests that are not perfectly aligned with yours. The other thing worth sitting with, scores are being used for things that go well beyond credit now. Landlords run them. Some employers run them. Insurance companies, in many states, use credit-based insurance scores to set your premiums. The score that was built to tell a bank whether to give you a mortgage is now quietly influencing whether you can rent an apartment in a city you want to live in. That was always true. But as the inputs feeding into these scores expand, the implications of your score being inaccurate or suddenly recalibrated by a model update expand with them. So, where does that leave you? Check which score your lender is actually using, not which score an app is showing you. Understand that FICO 10T rewards trajectory, not just current position, which means slow and consistent improvement now matters more than a single cleanup effort. Watch your BNPL accounts because they are about to stop being invisible. And treat the medical debt relief as a floor, not a ceiling. A removed negative is not the same as a built positive. All of that is practical. All of that you can act on. But here's the question I'll leave you with. As credit scoring systems become more sophisticated, more data, more models, more dimensions of your financial life being measured and weighted, does a more accurate picture of you actually make the system more fair? Or does it just make the system better at making decisions that were always going to advantage certain people over others? Because sophisticated and fair are not the same thing. And in a system that touches this many decisions about your life, that distinction is worth thinking about carefully.